Hi, everybody. My name is Ali Partovi. We're going to begin. I think we're missing somebody, but we're going to start. And yeah, one of the panelists, Mariela, is not here yet. Um, my name is Ali Partovi, and this session is about investing in sustainable agriculture. And my own background has been as a technology founder and investor. And to me, while I mean, we're here in San Francisco and sort of the heart of the tech industry. For me, though, what's appealing about... can you hear me better now? Is this any better? I guess we have to hold the... Can we turn up the volume, please? Oh, is that Mariela? Hi. Good. Yeah, they've said that we can't turn up the mics too high. I think just hold your mics close to your mouths, everybody. What I was going to say that is, as a, for me, having been in the technology world most of my life, you might be wondering how does that apply to sustainable agriculture? And what I would say is that, to me, Silicon Valley, the essence of Silicon Valley is not about the wanton application of technology for technology's sake. It's that the word technology stems from the word technique. And the philosophy of Silicon Valley is that if there is a technique that's superior, and that in some cases might mean a return to agroecology or to natural ways of farming, if there's a superior technique, Silicon Valley's philosophy is to have the optimism, the imagination, and perhaps the audacity to think that that technique can replace the older techniques and to scale and to change the world in a large-scale way. And so for me, I think of capitalism as a very powerful force for good in this way. For me, capitalism is not... I don't see it as a mechanism for hoarding wealth or preserving the status quo, but rather for generating new wealth and redistributing wealth and disrupting the status quo. So we're going to spend time talking about different ways to view capitalism and investment as a force for change, for positive change. And a key part of that is to try to figure out how to align incentives so that the changes that we want to accomplish come with greater profitability. So each of the panelists is going to give their own speech or presentation, and then we'll have Q&A discussion towards the end. I'm going to introduce first Craig Wichner. Craig is co-founder and managing director at Farmland LP, which, by disclaimer, I'm actually one of the investors in his fund. It's a real estate fund that acquires cropland and converts it to organic, in doing so increasing its profitability. So go ahead, Craig. I think I'll introduce each person in order, like after, before their presentation.
Very good. My name is Craig Wichner with Farmland LP. Give just a few minute presentation on what we do. Technical issues. Great. And the general talk is on the ROI of sustainable agriculture. So Farmland LP buys conventional farmland and converts it to organic, sustainable farmland as an investment fund, basically a real estate fund, as Ali said. And we were founded in 2009, so we've been doing this for about 7 years now. We currently own over 10,000 acres of farmland, worth over now $110 million, and farm another 3,000 acres on top of that as well. The farmland's in Northern California and Oregon in the Willamette Valley, and the Northern California farmland is just 50 miles east of San Francisco. And one of the properties is 1,500 acres, the other one is 4,200 acres. and that 1,500-acre property will be the largest organic, sustainably managed farm in San Francisco's 50-mile food shed. So we're excited about that, and it's already starting to produce, or already part of it is converted to organic and already producing organic crops. So now we're up at a scale where we have about 50 people, both finance professionals and farm professionals as well. We're also really quite proud of some of the awards that we've won for a number of years. We've been named by Impact Assets 50 as one of the top 50 investment managers in the world, actually, that deliver both financial returns as well as social returns. And B Corp, we've gotten one of the highest B scores ever, if you're familiar with that organization. So there's some fundamental things about what we do. Our general mission is to demonstrate that sustainable agriculture is more profitable than chemical-dependent agriculture. We know this to be true, and we're actually demonstrating it, in the process of demonstrating it on our financials and at scale. And the basic components of what we do are, number one, there's wonderful price premiums for certified organic, sustainably produced, and locally grown foods, and that helps really drive the top-line economics. We specialize in bringing livestock back onto cropland and managing the livestock and crop rotations, as has been done for basically 10,000 years of sustainable agriculture, and demonstrating that that works economically as well as agronomically. Diversity of crops is very important from a risk reduction standpoint, both from again, from an agronomic perspective as well as from an economic one. Economies of scale are something that are underappreciated but very important factor in the economics of farms. If you look at the USDA data, you do see that farms are more profitable as they increase in size as well, and we counteract that by actually managing the farmland, making sure it's certified organic, but then leasing a lot of that farmland out to other farmers so that they don't have to worry about the capital exposure on that land, but they can specialize and be great at what they do, but just rotate around the various farms. So we get the benefits of both sustainable agriculture crop rotations and specialization. Finally, we're able to work with some really great strategic partners as well, whether it's on the processing, distribution, or the production side. We're at a pretty amazing point in the development of the markets. It's brand new data, but Costco is now the largest seller of organic foods in the United States. $4 billion a year, nearly 10% of the amount spent on organic foods. They now beat out Whole Foods. So we're past the evangelist stage of organic food, and we're now at the point where the CEO of Costco is saying we cannot get enough organics to stay in business day after day. So the whole market is constrained by the lack of organic food. That means there's absolutely tremendous consumer demand on there, and the farmers are just simply not growing enough organic food, and that's caused by the lack of organic farmland, which is needed to grow the organic food. So it really creates a tremendous opportunity, and there's really tremendous demand by the very, very large companies to increase the pace of conversion of organic farmland, but it takes 3 years. So, and they're kind of surprised. Can't we just build another factory? Can't you speed that process up? No. And there are actually companies that have very nice $350 million businesses that are the largest. There's one company, the largest grain buyer, organic grain buyer in the U.S., and they say they could triple their business, but they just don't have enough organic grain supply to do that. So it's a really pretty amazing market situation. Here's a graph of the growth of the organic food demand, and that's growing at 15% per year, yet the supply of organic farmland is only growing at 6% per year. So organic farmland conversion is not even keeping up with the pace of demand growth that's there. And again, this market This 15% growth, the 5.5% of the U.S. food budget that's spent on organic food, that's in the face of the constraint of not having enough supply. If there was enough supply, these numbers would be a lot higher than that. The natural demand for this is much higher than what we're seeing right now today. What's the scale of the problem? So that gap is about an $80 billion gap. If you could convert $80 billion worth of farmland, you just kind of meet the gap for where it is today. And if you kind of think about how big is the farmland market in general, there's about $2.4 trillion worth of farmland in the United States. And to put that in perspective, that's about the same economic value as the value of all of the office buildings in the United States, or all of the apartment buildings in the United States, or all of the shopping malls and retail space in the United States. It's about 1/10 of the value of all the homes in the United States. So the amount of farmland is really quite massive, and about 40% of farmland is leased. So it is commercial real estate. It's a form of commercial real estate. And we specialize in taking that real estate, that 53% of U.S. cropland grows 2 commodity crops, corn and soy. We specialize in converting that from those commodity crops to high-value organic and sustainably produced crops. Make sure that is managed well in perpetuity as using sustainable agriculture best practices, so that farmers can produce the food that people really want. And just by way of highlighting, only 1% of farmland is institutionally owned in the U.S. So it is a very fragmented, inefficient marketplace, and you don't have to worry about. Let's talk about $10 billion worth of farmland, institutional money coming into farmland and buying farmland. I wish much more of that was going into organic and sustainable farmland. But the key point is, even $10 billion out of $2.4 trillion is nothing, basically. So the benefits of sustainable agriculture are many. One component is the price premiums. I have up here on the graph some examples of the price premiums from various vegetable crops. 50 to 200% price premium is something generally that we talk about. Some of the premiums are higher than that as well. Organic and sustainable agriculture delivers increased financial results. Creates 3 times more jobs per acre while still being more profitable as well, and delivers wonderful ecological and societal benefits, which I think all of you guys are familiar with. This combination really makes it compelling, both from an investor perspective as well as from the perspective of human beings. So with that, quick summary. Thank you very much.
Sure. Thank you, Craig. So I'm going to ask you a question, and then we'll pass it on to the next panelist. I would love to hear from you the profitability. Most people assume that the profitability comes from converting to organic and being able to charge a higher price for the words organic, essentially. If you were instead actually selling your product without calling it organic and not commanding that price premium, would you be making less money or more money than someone who is growing conventionally? And if it's and does that change over time?
Are you talking about just the price premium for organic, or
meaning if there were no
cost?
price premium for organic, if
it was all the same cost?
Exactly. If you couldn't sell it for more than conventional goods.
Great. So and there really are a couple pieces to the answer. One is that we talk about the organic price premium just because it's so well documented and it's very easy to talk about. But there's also a sustainably produced price premium, grass-fed beef. It's not organic, but it's grass-fed, and people pay a premium for that. There's also locally grown. People actually prefer a locally grown product 2 to 1 over something even that's certified organic but imported internationally. So there are actually a number of price premiums that are there. But one of the important things about what we do is we don't really rely on the certified organic price premium. We like it. It helps us convert the land. But it's the sustainable agriculture rotations that once it takes at least 3 to 5 years to really start kind of restoring the land, bringing back that biological soil fertility in the land, which actually then reduces your costs, reduces your input costs, reduces weed pressure. We actually have our organic fields, when we take them out of pasture after 3 to 7 years, have far less weeds than conventionally managed products. These are the vegetable growers who are telling us when they produce organic butternut squash on our land that our fields are the least weedy fields of any fields that they farm, whether they're other organic or conventional fields as well. So very strong lowering of costs. So over time, then we expect that even if we had to sell the products at the same price, that because the input costs would be lower, that the farmers would be more profitable in that. So sustainable agriculture works both agronomically and economically over time. And what the investors are doing is essentially enabling us to bridge that transition process. And so it's a very nice synergy.
Thank you, Craig. So next is Libby Bernick. She's Senior Vice President of North America at Trucost. Go ahead, Libby.
Well, thank you. It's a pleasure to be here. For those of you that are not familiar with Trucost, we're a London-based research firm. And for the last 15 years, we've been working with businesses and investors to put a monetary value on these environmental costs, these externalities. And our aim in doing this is to direct capital towards more sustainable business models. So when we talk about investors, I think it's interesting and from how many different perspectives there might be on investors. And I liken it to talking about food. So when you think about food, we might have a McDonald's, and we might have, in contrast to that, a Green's restaurant where many of us ate last night, and we have Cisco. We also have local farmers markets, and we have the entire spectrum imaginable of different kinds of businesses. Well, when I think about investors, it's the same thing. So you just heard about private equity, venture capital. You're going to hear about development banks. I'm going to speak to the investor perspective of pension funds and institutional asset owners. So for those of you not familiar with that, institutional asset owners, these pension funds hold about 36 trillion in wealth. About 22 trillion of that is in the US. And we work with most of the large asset owners around the world. And what I wanted to do just very quickly is share with you what we see as 3 trends as to how these institutional asset owners are looking at environmental issues, and then plant a seed with you as to an idea that I think might take root, and then leave you with our point of view on what's missing from the conversation with investors. So the first trend I want to share is the notion that these large institutional asset owners are now starting to measure the environmental performance of their portfolio. So these holdings in their portfolio might be equity, about 35% on average. They could be bonds, but up to 35% of their holdings could also be in real assets like agriculture or timber or the like. So what we're seeing increasingly within the last 2 years are these asset owners, these large pension funds, measuring the environmental performance of their portfolio. Not just equity, which we started doing 10 years ago, but actually the real assets. So as an example, with one of the sovereign wealth funds in Australia, we just recently measured the carbon footprint of 12 New Zealand dairy farms within their portfolio. So why are they doing that? Because they want to know how they're financing carbon emissions around the world. So this trend by these pension funds to measure their portfolios and understand what environmental risks and benefits is very real, but also something that is a great opportunity for the sustainable ag community to get involved and be part of the conversation as to how do we measure what is and what are the sustainable benefits of agricultural systems. The second trend I wanted to highlight for you has to do with green bonds. So there's been an upsurge in the issuance of green bonds. Just last year, $14 billion were issued. This year, it's on track to issue about $50 billion in green bonds. So again, another kind of investment. But again, what's important is that standards are being written as we speak for how to look at agricultural systems as part of these bonds. And to the best of my knowledge, the kinds of issues that we've been talking about the last 2 days here are not part of the conversation. It's largely focused on carbon. And so I think it's a great opportunity for all of us to get invested in that conversation and be at the table as standards are written for how green bonds can be directed towards agricultural systems.
Go ahead. Can you explain what a green bond is for those who might not know?
So a bond is fixed. Okay. A green bond is a bond that's directed towards a greener project. And historically, it's been directed towards wind or alternative energy systems. And increasingly, the definition of green is expanding. Great, thank you. So the third trend that I want to highlight for you is that these institutional asset owners are increasingly trying to make the link between environmental performance and their financial risk. And as you were speaking about the financial performance of your farms, so too are these investors looking at how their risk or reward could be enhanced or attenuated by the green factor. And what I want to leave you with is an idea. Lloyds, the fourth largest bank in the UK, recently announced that they are going to provide $1 billion in financing for commercial building owners who have green buildings. And the reason that Lloyds did that was not because they just wanted to be good corporate citizens, but because in working with them, we were able to demonstrate that their credit risk was lower by actually investing in these buildings. So the ability of those building owners to pay back their loan over time was actually better because they weren't having to pay more for electricity. So making this link between environmental performance and financial risk is something I think that we need to have as part of the conversation. And then the final thing I want to leave you with is just our perspective on what's missing from this whole conversation about investment and sustainable agriculture. And really that is, how much investment do we really need to turn things around? How big is the number? And I've never seen any sort of definitive answer. And I think we need to get in line and come up with that number because there's a lot of other issues asking for capital to be directed their way. So for example, when we think about carbon and climate change, there's estimates that we need $100 trillion in investment to fix our systems and make them more resilient to climate change. And there's been some numbers floated that we need $7 to $14 billion for our agricultural systems to adapt to climate change. But that's not even talking about the issues that we've been talking about here. So until we get at the table and start to put a number down in front of people and these large institutional asset owners saying, here's what we need to fix the problem, I think our needs will go unmet. So thanks. I hope I've provided some perspectives about what some of the current issues are and where we as a community can get involved in the conversation.
Thanks, Libby. I'm thinking, listening to both Craig's talk and now yours, you can pull out from each of these different ways in which the values that I think we all share in terms of what's a better form of agriculture can be presented as sources of essentially of profit. Craig talked about the premium that terms like organic or sustainably produced command a premium in the marketplace. That's essentially consumer preference. Consumers would rather pay more for certain types of agriculture practices, and that consumer preference results in higher profit. And you just pointed out that another driver of higher profit is risk reduction, that essentially if you have a high carbon footprint, that equals risk, whether it's the risk of future regulation or future carbon tax, and that risk is a very real cost. It may not be a cash cost, but it is very real, and accounting for it properly results in a change in your bottom line. And so those are two very different ways in which producing food and running agriculture sustainably can actually be more profitable.
Absolutely, and it's a great point. A lot of these institutional asset owners are asking, how do we get environmental risk out of our portfolio? So you've got the portfolio decarbonization movement, where you've got 25 of the largest asset owners around the world pledging to take $600 million of their investment out of high carbon systems. Well, guess what? If they take it out of high carbon systems, they have to put it somewhere else.
Right.
So can't we line up sustainable ag to be the place where they put it instead? So to your point, there's a lot of ways to look at it, and risk being one that's very important for these institutional asset owners.
Well, those are two. Hopefully, over the course of the session, we'll come up with some more as well. But I'd like to introduce our third panelist, Randy Hayes, Executive Director of Foundation Earth. Go ahead, Randy.
Hi, everybody. These mics are a little screwy. Can you guys hear me in the back rows? Okay,
Yeah, you need
good.
to hold it right up to your mouth.
Yeah, you got to eat these things like an ice cream cone or something. All right, so we're here for a panel, right, on how to think about investment in the sense of building a true cost economy, or at least achieving true cost agriculture. So I want to start with my conclusion. My conclusion is that we must undercut the profitability and the profit advantages of toxic farming in what we could call cheater economics, the cheater economic system, right? And so we have to undercut the profit advantages of the bad players. If we do that, if we can rally to that sort of daunting task, then I think we stand a chance, conceptually at least, a chance to build that sort of more socially just, ecologically sound society in our lifetime. We could have perhaps, see that great sort of societal U-turn in the right direction. But if we don't focus on that aspect, along with all of the good things that need to be done and examples that we've heard about throughout the conference and with other panel presentations, I don't think we're going to have a winning strategy. So how do we undercut the profit advantages of toxic farmers, right? Or toxic industry, let's call it. With every campaign, you've got to, in the simple sense, you've got to stop the bad and start the good, right? And so in terms of money and investments, you've got to shift a lot of the bad money towards the good money, right? The more you can shift that money, but we need to think of it to some extent in a quid pro quo kind of fashion, not just where do we find other pockets of good money to add to the mix. We've got to undercut the money that's going to the bad players, because if you look at the G20 level, if we want to think about the scale of the dilemma, the G20 is trying to amass up to $80 trillion to spend over the next 15 years. So not billion, $80 trillion to spend on what they call infrastructure projects. Well, the word infrastructure hides a lot of sins. If that infrastructure are nitrogen and phosphate plants for industrial agriculture, if it's, trans-Amazon highways and railroads on top of the existing one, or the same kind of thing across the Congo for Africa, just to foster industrial agriculture in a kind of business as usual sense, we're just not going to get the job done, right? So how do you get banks to begin to stop funding the bad and start funding the good? To that extent, I worked with Dan Imhoff, who was on the last plenary panel and spoke about the 50-year ag farm bill, right? And so Dan and I, and Honor Eldridge, who's in the audience here, did this, and we worked hand in hand with the Millennium Institute and Hans's group in Washington, D.C. And this was Biosphere Smart Agriculture in a True Cost Economy, recommendations to the World Bank, okay? And what we tried to do essentially with this report is take a look at the World Bank's climate smart agriculture, which is a little bit fewer greenhouse gases and a lot more GMOs and a whole hell of a lot of business as usual to support giant agribusiness. Okay, it's not the paradigm shift that we want. And we took one particular loan to Senegal. I'm forgetting the exact number, but think of 150 million or something invested in industrial agriculture to grow flowers to ship to Europe. And then Hans and his team at the Millennium Institute, they have a computer model called the T21. And we said, okay, if you took that same money and you invested it in agroecology, ecological farming, how many more jobs, how much more local social good, how much less water, how many fewer pollution externalities would there be? You know, and just rounding off, it's kind of like a 3-to-1 advantage if you do that, right? Okay, so that's all in the report. But then we also said, okay, well, how do you get the World Bank to do these kinds of things? Because it's a recalcitrant giant institution. I have some history with the World Bank. We did in the 90s get them to stop funding hydroelectric dams in the Amazon, not just Rainforest Action Network, but a whole lot of groups around the country and around the world. Now they're going back into it. They want to fund a hydroelectric dam complex greater than 3 gorges in China, which is so heavy, right? It's causing earthquakes over there, and so much the wrong thing. But nonetheless, you know, you've got to deal with these characters, because if they lock us into these kinds of old paradigm infrastructure projects, we're screwed for the next 30 years. That money is amortized over a long term, right? And if it just locks in industrial agriculture, you know, we're just in trouble. And all the boutique efforts that we do in pilot projects, which are heroic, important, and need investment and help to get to scale, still won't get the job done. We won't have a winning strategy. We'll have 2 steps forward and 4 steps backwards. Well, that's how we could describe the last 40 years, right, of the social change movement. So in this report, we laid out 4 simple steps to the World Bank, and we presented this to the head of the Climate Smart Ag program at the World Bank. And it essentially says the bank has got to set up internal procedures to identify and quantify these ecological impact externalities, right? Especially at the front end of the agricultural loan stage, to show the true cost of production. And not only do they then just identify and daylight these pollution externalities, like the good work of Trucost, they've got then to size those externalities up against the planet's already stressed life support systems. There's, you know, a new scientific framework on the planet's life support systems called planetary boundaries, and Jonathan Foley spoke about it and showed a slide on it, but it's the same way that we've been thinking with our work, right? And so you can see in this chart that green in the very center, if your activity is within the green zone, you're at least not undercutting the planet's ability to support life. But of the 9 different categories, 3 of them are off the charts. And even though climate change has kind of the, you know, the attention of the planet, it's not our biggest problem, right? You look at biological diversity and extinction and habitat loss, and it's really off the charts. You look at the 400 dead zones in the ocean, the bottom of the food chain, and it's off the charts more than climate change. And guess what? In aggregate, you can consider industrial agriculture the biggest emitter to the climate change problem. The 400 dead zones in the ocean are from nitrogen and phosphorus runoff, and that's completely industrial agriculture, right? And the major cause of habitat destruction and species extinction, the 6th great extinction, is agriculture, right? And so Foley made the point that we simply have to kind of shift the thinking. If you achieved overnight with a magic wand 100% renewable energy, 404 parts per million stays pretty much at 404 parts per million. But 280 parts per million is what the Holocene in nature gave us. And we, of course, have to learn to live within the ways of nature. And that means our real goal is to get back to 280. And you can't do that unless you convert industrial agriculture to agroecology globally. You can't do that unless you double the native forest canopy globally. Those 2 carbon sequestering kinds of activities could save the day, could be the stuff of that giant ecological U-turn in the right direction, right? So we said to them, have the internal procedures, right, to identify these externalities, size them up against the planetary boundaries, and then guess what? Say no to additionally damaging forms of agriculture and fund agroecology, which is restorative and regenerative, right? And then the fourth point is just simply that you've got to incentivize the bank loan officers to do this, or the son of a bitches just won't do it, right? I mean, it's just not going to happen. So that's the kind of stuff. And we just told them this in straight talk, right? Well, they actually listened a little more than we expected. I was just shocked, and they invited us back. Well, they're mid-level management people. They're not the senior vice presidents, and we haven't gotten to the president of the World Bank, Jim Kim. He's a medical doctor who used to run Dartmouth University, and he's a good humanist in many respects. He was good on Ebola. He so doesn't get biological diversity. And the fact that, you know what, there's no vibrant economy, there's no food security, there's no social justice on a dead planet or a near-dead planet. And that's what's happening, right? And industrial agriculture is the main culprit. I've probably gone on enough, right? There's more.
No, it's all interesting, but
well, there's more I can say. Just a couple little more words, and then I'll work the rest into the Q&A, right? But so you've already heard my conclusion, and you know, we're hearing at this conference. There's 4 types of externalities, right? There's social externalities and there's ecological externalities, right? And then there's positive externalities and negative externalities. But I'm really focused on stopping the ecological impacts, those ecological externalities, because of that point that there's just no social justice or anything on a dead planet, and that's what we're facing right now. That's how serious this situation is, right? So, and it's not about internalizing them, or language is important. It's about eliminating them, right? So we can say things that they're kind of cute and fun. Let's internalize the externalities, and I do that all the time. But what we really have to do is eliminate these things, right? And so the problem statement that I would put forth is that we really have to, that in fact, cheater economics would be the best label of capitalism. And the most profitable companies like Walmart are because they're giant externalization machines. They know how to externalize social and ecological costs and squeeze their suppliers better than anybody else, right? And that's cheater economics. And cheater economics is not only poisoning people, but it's killing the planet's ability to support life, right? And so we have to demonize the enemy and have the guts and gumption to do that. You know, no campaign has been successful without being able to deliver some tough love when it's needed. It's nice to be positive and think of that, but I just don't think it's going to get the job done, right? So these giant agricultural companies are the stuff of using the cheater economic model, and they're the #1 planet destroyers. They're the #1 pollution externalizers. They're the #1 cheaters of future generations. And they're the #1 cause of the 6th great extinction, and so. We've got to also speak in those terms and see that this movement organizes in those terms. Because if we stay too goody two-shoes trying to foster the boutique stuff up to greater scale, we're going to lose big time. If we haven't already lost, Woody's going to probably depress us when he responds, because I know his level of optimism. It's less than 1%.
So Randy,
but the last thing I'll say is just simply that the part of the campaign plan, a big part of the campaign plan, is about, in fact, demonizing the enemy and getting people that political PowerPoint from the last panel to make the demands that we end those subsidies, you know, that we end the insurance and the direct subsidies, and we undercut their profitability, because as long as they're more profitable by cheating, we aren't going to win.
So I want to move on to Marielle in a second, but when we come back to discussion, I'd like you to think about, listening to you raised for me the question, when you talked about creating incentives for the loan managers, you know, it begs the question of, is there a way to also actually create incentives for the bank itself and to make it so that they make more money doing the right thing rather than merely doing it because it's the right thing? And because I think that's, if you can figure out how to present it that way, that makes it a whole lot easier, because you're on the same side of the table as they are. So next I want to pass it on to Marcela Cedeño. Is Cedeño correct?
Cedeño.
Cedeño, sorry. and she works at Mandela MarketPlace as the director of social enterprise and microfinance.
All right. So I was going to do this whole slide thing, and I'm realizing that makes zero sense. Exactly, right? All right. So I'll just leave it. Actually, I'll leave it here. So hello. We were just talking about the World Bank and some giant stuff, and I'm going to bring it to West Oakland, which is an interesting change. So my name is Marcela Cedeño. I'm the director of social enterprise at Mandela MarketPlace. We're a nonprofit that works mostly in the East Bay, and the nexus of our work is really building health while also building wealth in low-income communities of color. And I've been sort of struck yesterday and today by a few things that have come up in my mind as we have these conversations. One is that low-income communities of color don't exist in these conversations that we're having right now. Like, when people talk about sustainability, they're not talking about East Oakland or West Oakland or the Bayview or the Tenderloin. They're talking about more affluent communities that are able to have these conversations. The other thing is this idea of of consumers clamoring for organic, right? And sort of like what that context is. One is the idea that people know what organic is, and two is the idea that people can pay a premium for organic, right? So I kind of want to just explicitly state that right now, because that doesn't exist, again, in the places that we work. And in fact, because it doesn't exist, and because the communities we work with are so often disenfranchised in that conversation, is why we do the work that we do. So I think it was yesterday, the guy from Whole Foods was talking about like health inequities and food access, and it like struck me as ironic that he was the one bringing this up, because they're not necessarily the folks who are solving the issues that can solve the issues, right? So we became a nonprofit because in West Oakland there had been a lot of studies done by various groups about health inequity, right? Even looking at Alameda County, places like West Oakland and East Oakland have 4 times the rates of diabetes, of asthma, of heart disease, of all these things that are environmental, either related to the environment or related directly to diets. And they were trying to figure out, not necessarily why, but tell people about it, right? So they kept having these like caucuses where the residents would come and here's the data of how unhealthy you are, and here's the data of how many like McDonald's there are in West Oakland. And people were like, that's awesome. We know this, right? Like, we're constantly having to go to the emergency room. The only place we can go eat is McDonald's, or take a 2-hour bus ride to Emeryville or San Leandro or wherever to get real food. And so there was a group of people who wanted to do something about it, which are those folks on that slide right there. And so a lot of people came together. It was agencies and CBOs and residents and all these folks, and came up with this brilliant plan of how to create a food system that not only built the health of West Oakland and the East Bay generally, but also built the wealth of the people that were living in these neighborhoods, right? And so to bring it back to the investment side, what we quickly ran into is that everybody who was at the table was super poor, right? So the grocery store, which is a fairly small one, I think it's about 2,500 square feet, was going to be like a $750,000 to $1 million project. And the folks at the table didn't have houses, they didn't have cars, they didn't have bank accounts, they didn't have full-time jobs. And so we incorporated as a nonprofit to be able to pull some of the assets that were being put towards these things directly into a community project. Does that make sense so far? Okay, so that's the Mandela Foods Co-op. And actually, all right, so that's the Mandela Foods Co-op. It's a worker-owned cooperative. There's 4 worker owners right now and 4 employees. Since they opened in 2009, since then we've also opened a cafe that's also locally owned. There's an owner and 2 employees also. We also have a wholesale distribution company that sources locally from sustainable growers and brings that food into West Oakland. And then on top of that, we do a lot of work around food access. So we run pop-up produce stands. We work with liquor stores to sort of incentivize them to carry produce. And we also work with hospitals, schools, and health centers to figure out ways to incentivize people to change their consumer patterns. So doing matches, that sort of thing, that's very popular right now. So I guess, for me, I didn't want to talk too much about what we do, though now you know what we do. I wanted to just throw into the conversation that, how incensing it is for me to, sit in these forums and hear people talk about, sustainability is so great, People are willing to pay a premium for organic. Let's think about the Trucost of these things, but we don't think about the communities that are most affected by it, right? The communities that are most affected by the environmental impact, that are most affected by a lack of healthy food, that are most affected by a lack of economic power and political voice in all these things. So, hold on, I'm going to move to the bottom of this. So, blah, blah, blah. Okay, so I'll go here. So we're talking about sustainable food specifically. Most of the farmers that we work with are fairly small. Like our biggest farmer, I think, has 200 acres. Most of our farmers have between 5 and 30, right? So they're tiny, tiny farmers. And even though they are growing organic and they're making that decision to grow organic, and most of them have been farm workers that worked on conventional organic farms that have made the transition to being farmers, they don't have the markets that we keep hearing about, right? We keep hearing about how Costco can't find enough organic. Like, well, I know that a friend, for example, last year lost 40% of his crop because he couldn't find somewhere to sell it, and because folks that would buy it aren't paying them fair prices, right? So they just choose to not do it. And so a lot of the mechanisms that we've created around investment specifically haven't been because we want to become a bank. They've been because we are working with completely unbanked communities, right? So with our farmers, for example, a lot of them are undocumented, right? A lot of them haven't become organic certified because it's super cumbersome on the documentation. It's expensive. It's in English, and so again, it's just layer after layer of things that they have to get through to even get to the same playing field as what we've all been talking about here. So we have 3 things that we work with. One is a super small microloan through Kiva Zip. I don't know what have you guys heard about them? It's sort of like an online marketplace for lending. And that's how we start building really small micro food entrepreneurs. We have our own loan fund that we built through Freshworks Fund, which is a California $300 million loan fund. So they were having a really hard time, even though the incentive was to do these sort of mission-aligned grocery stores. They hadn't done a single one. They did a $45 million new market tax credit, and that was the smallest loan they had done. And so we sort of pushed back a lot, and they started figuring out how do we work with intermediaries that will take on a loan, will take on the debt and have the balance sheet to do so, who then will take on the risk of lending it to the people that we wanted to, but we can't. And then our last one is, which I think it's our newest one, and it's the most interesting to me, is our harvest to market loan. So a lot of our farmers who have found markets to grow into at the beginning of season don't have the money to actually buy seeds, hire workers, do all these things that they need in order to fill these accounts. So we created this purchase order advance loan where we do price negotiations, so it's actually a flat rate. It's like an average rate for the year. And then we advance them the entire amount of the purchase order. The loan fee that's charged gets wrapped up in our markup because we also sell it. So we have a distribution company, we have the grocery store, we have the corner stores, we have produce stands, we have sort of a captive audience. And they end up paying us back in produce. And then as we sell that produce, we replenish the fund. Does that make sense? Yeah, so, okay. So this is our cute little local food system, our farmers, our distribution company, our grocers, all these cute little brown people. Anyway, so I guess I wanted to get to this last slide, which is the takeaways, because again, I don't think this is going to be said anywhere else. Again, I want to restate that low-income communities of color are totally left out of this conversation. So it's just something that I want to leave for all of you guys to think about as you think about sustainability and as you think about these like very macro topics of like how does that actually affect people and communities that are getting disproportionately affected by the consequences of not having sustainable systems. The other part is that there actually is a huge market gap in these communities, right? Like Whole Foods isn't clamoring to open in West Oakland or East Oakland or in the Bayview because it doesn't make sense to their business model. So a lot of the solutions that we're working towards is like how do we fill those market gaps but also create local businesses so that the market that's being created that's already there, that's usually leaking out to other places, that money's being kept in the locality that we're looking at, and that it's also bringing healthy food to locations that we're looking at, right? Food economy is a huge catalyst, right? You don't have to train somebody to be a scientist or work in biotech or whatever people want to do these days, which is valuable, right? But it requires some level of education. Food is a pretty low-hanging fruit. It's culturally relevant. Most people cook at home or have grandparents cooked at home that they can get some recipe from. And then also that our current capital systems are not accessible, right? So when we're talking about, like, I hear a lot of, like CDFI is talking about that they don't have enough places to put loans to. Not necessarily true. They're just not willing to take the risk in the loans that might make the most sort of benefit for a community that we work with. And then the last thing, which gets back to the co-op piece that the lady from Organic Valley was talking about yesterday, is that ownership is asset building, right? It's not just about the wealth and the health building part, but we talk a lot about it in the frame of financial and political voice, right? So folks who didn't have bank accounts now have bank accounts now, and they also have a business, and they use that business to then create a political voice in a system that often leaves them out. That's it. That's my rant for today. Thanks, guys.
Well, thank you, Mariela. That was an excellent rant. There were a couple of things I would want to respond to, but I'd like to first give a chance to Woody Tasch. There were not enough seats, but the last speaker sitting here in front of me is Woody Tasch, and he's the respondent, so to speak, for the panel.
That's all right.
Woody is the founder and chairman of Slow Money.
I have two chairs now. It's good.
Just take them both.
I might not take either one. So I was asked to be a respondent, and before listening to this, I was thinking of responding to some of the other stuff. So I'm going to try to do both in a few minutes, and therefore I'm not going to try to connect everything. I'm just going to try to say a few thoughts in response. So before I do, for those of you who don't know what slow money is, I have a few slides, but they're not about slow money. I didn't want to try to do that. They're about the ideas behind the public conversations, part of which we're having here. If I was trying to frame my response to what I just heard, I would say the kind of cross-cutting frameworks are institutional versus individual and global versus local. So most of the conversation until we got to Mariela was about institutional. And then she got to she mentioned Kiva Zip and a couple of things. I mean, Craig is kind of straddling the line a little bit. He's got individual investors and institutional investors, and he's scaling into institutional. But if we think about investing, if you think about the word investing, it's like, who's doing the investing? Is it institutions doing the investing or individuals investing our own money? Slow money is about individuals investing our own money as locally as possible. So you can see we have a certain niche in this thing. And then I was also, so I'm going to just stick with me. I'm going to try to weave this all together. When Randy went on his little, he was ranting too. I think they were both ranting a little. That was kind of a curmudgeon's rant, and this was a different kind of rant. I'm not going to try to put a label on it. You might get mad at me or something. I don't know. So you said something about it was about demonizing the bad guys. Oh, you said about you were worried that if we tried to scale up the boutique-y good things, we'd never get enough done. And I thought, Jesus, I think I'm trying to scale up the boutique-y good things. And I thought, well, why do I think it might work? And I realized what I feel like Slow Money is trying to do is plant seeds, which is different from trying to scale up a bunch of boutique-y things. Plant the seeds of something called nurture capital, which would be a radically different way for large numbers of individuals to think about putting their money to work locally. Now, you could argue it's quixotic because we're not going to get enough individuals to do it. That would be, and I don't think we've ever been on a panel together after all these years, so it's kind of fun. So I'm just going to tell you a few thoughts that come from 6 years of, we started about the same time Craig started. In fact, he was one of the first presenters at a Slow Money meeting, and maybe a few $100,000 of his $100 million came from some Slow Money investors. During the same time that Craig has grown to 110 million, whatever you said, Slow Money has facilitated over $46 million of investing in almost 500 small food enterprises from 1,500 individual investors over 6 years. So if you do that math, you'll see it's a lot of small stuff. The deals have ranged in size from basically almost crowdfunding kind of things, a few $1,000 up to a few $1 million. And we have all this data available in different forms on our website if you want to find out about it. Whether that's going to amount to something, the wrap on it is it's inefficient, it's slow. We call ourselves Slow Money. It's not a joke. And I do have 3 slides that I wanted to show that have to do with thinking. Slow to me means about thinking long term. It means about being willing to radically rethink what our demands are as investors for what kind of returns we want. Like, who gets the returns? Do we need them, or maybe the future generations need them? How much return we need for how much risk? And we've been having a public conversation around the country, a little bit in Canada, and a tiny bit in France, about this, and we have engaged 1,500 investors and 4,000 donors and moved some money. And whether you think $46 million is a lot or a little, it all depends. Institutionally, it's nothing, right? I mean, Craig, you said $10 billion was nothing, or whatever you said that number was. No, and it's true on that. It's all a question of which scale and which thing you're looking at. For individuals, 46 million bucks into 500 things, pretty cool, I think. We'd like to be $500 million or $5 billion, we would, but with lots of small direct things. So I just want to again say I think it's useful to all of us as a framing thing to think global versus local and institutional versus individual, and there are different places to play on all those things. Now, where do the institutions get their money? From us. It's actually our money. We gave it to them. Okay, once we give it to them, it's really hard to get them to do what we want them to do with it. Why? Because there are all kinds of rules and regulations and securities laws and perverse incentives. And there aren't that many people, including all of us in this room, who if you were sitting on a pot of money where like 1/10% difference in the return made $1 million difference to you in your bonus, how many people wouldn't do the thing to get the $1 million bonus? So and this is where I get a little bit the demonizing thing, I think. People are people. They do the best they can, and not everybody on Wall Street is a greedy asshole. I have a lot of friends who work on Wall Street, and some of them are greedy assholes, but most of them aren't. No, I'm not. I just happen to be gazing in that direction. So I just, again, I think I once found myself saying the following: we are giving our money to people we don't know very well to invest in things they don't understand very well halfway around the planet where none of us will ever visit. Does this sound like a recipe for a healthy future? No. Okay, but we are giving them our money. That's what this is really about to me. So it's about us taking a little of our money out of there and putting it to work in things that we understand. And so it's a kind of a cross-cutting issue. It doesn't solve all the issues because the local thing has all kinds of sociological problems with it in terms of everybody isn't local to everybody else, and there are all kinds of problems there. So I said I was going to try to respond, so let me finish responding. Before we came into this room, I was listening to the other conversations, and we were talking about farmers, consumers, and policymakers a lot. Not that much about investors, but obviously in this room we're talking about investors. And I just made a note to myself to emphasize institutional versus individual. Really, really important distinction. Otherwise we don't know what we're talking about. What are we investing in? Other than, let's leave farmland out because that's a very unusual category. It's an asset, it's land, it's a very different thing. If you're talking about investing in enterprises, then it's what kind of enterprises, and then you get to the issue of public companies, private companies, co-ops. You got to start thinking about what kinds of enterprises are receiving the capital, and I'm really glad you mentioned Teresa Marquez from Organic Valley, and I love them and I love her, and the whole idea of co-ops is very important, has to be part of the conversation for all kinds of reasons we don't have time to get into. Joel Salatin mentioned this morning that he thought what he was doing was healing the land. He said something, remember he made the comment, he said, I'm not really growing food, I'm healing the land. Well, I think we have to heal our psyches as investors. I mean, it's the first thing I thought when he said it. Meaning, probably everybody sitting here has money in Monsanto, whether you know it or not. And the whether you know it or not part, to me, is a matter of healing. It's it's bad. Our money is flowing into things that we can't control. We wish it wasn't. We try to put regulations and create green products and other alternatives, but some of our money is still going in the direction we don't want it to. Now we can't stop that. We're all complicit. Wendell Berry talks about us all being complicit, and of course we all are. But at least we can begin to heal it by thinking about it and by taking some small actions to take our money out of that. To me, the only thing I can actually think of to do with my money that is pure is making a small loan to a farmer in my community. That's the purest thing that I know how to do. I'm not arguing that you have to agree with me. I'm just saying, to me, that's... And so Slow Money is doing that all over the country. We've got maybe 30 groups around the country. They're very small. They're kind of quirky. Where's Arno? Is Arno in this room? Arno and Louis are here from Slow Money, Northern California. And we basically do it by, if I say the words, I think this is all I have to say in this group, the CSA of investing. That's what we're doing, whatever that might mean to you. And then I just want to do a few, let's see if I responded to everything. Oh, I just want to say a couple of other quick things. Just to be more concrete, here's an example of the way we are doing it. There's a group in Carbondale, Colorado called the Two Forks Investment Club. It's actually called Two Forks Club. We got rid of the word investing because it was too confusing. Why? Because the money is being put in as donations. 25 people have donated a total of $100,000 in sizes ranging from $150 to $30,000. Those are the individual donations. Everybody gets one vote, doesn't matter how much money you put in. Got to think about that for a second. And we are making 0% loans to small food enterprises in the Roaring Fork Valley in central Colorado. We've only made one loan so far. We're about to make 2 or 3 more next week. And, is it going to make a difference? Who the hell knows? But we're trying. So I just wanted you to hear that idea. Donations in, 0% loans out. If we did it for a long enough period of time and enough people did it, very gradually it would scale into a permanent community revolving loan fund. And then I wanted on the co-op thing. I just wanted to, Craig. I don't know if you even know this. There's a group in Fort Collins, Colorado, that is called Poudre Valley Community Farms. You guys can all go check it out. They've created a co-op to allow individual community members to be part owners of the farmland. A really great farm family realized they are never going to be able to own any farmland there. 50 acres came up for sale, right down from where they were renting their 6 acres that they were farming intensively. It's a very successful, small CSA organic farm. And they said, you know what? Let's get the community to buy it. We just want a long-term lease. And so they, working with the county, they got a conservation restriction, and they're getting 100 people from the community to put in $2,500 a piece to be members of the co-op to own the farmland. If it works, it's not a done deal yet. We're trying to get it all to happen. It may be an interesting model for community ownership of farmland. And then if you just stick with me one more second, I'll just do these really fast slides. So the thing about planting the seeds of nurture capital, which is different from trying to scale boutique-y good things, is sort of getting enough historical perspective on what we're talking about when we're talking about investing. We say investing like we know what it is, and we all grew up. Now I'm saying the we like the gray-haired we's. I don't know about you other guys. Meaning from roughly 1950 or 1960 to today, that's when all the technology and capital markets and everything just exploded. So if we said things like what the daily trading volume on the New York Stock Exchange was in 1960, anybody want to guess? Someone guess something. How many shares? We have 100,000. That's a little too skeptical. It was 3 million. 3 million shares a day in 1960. And now, depending on how you count, it's hard to compare apples and oranges with all the exchanges merging and everything. But it's 5 billion, 6 billion, I don't know. It's billions. So during a period when global population went up, whatever, went up 2.5 times or something during this period, volume on the stock exchange went up 3,000 or 4,000 times. So money is just taking off. It's accelerating, and it's becoming, I think we would all agree, detached from people and place. So in that same period, this last one is meant to be very provocative if you're in a room of Silicon Valley people, because it says venture capital returns. And we don't have time to get into all that, but I just say, what are we comparing, where do we get our return expectations from? How do we understand what risk is, or how much money we need to get compensated for doing what? We're under the shadow of something called venture capital, which is a very particular high-tech, capital-intensive form of investing, and that model is not appropriate for a lot of the things we want to do. So let's, Craig, if you'd be so kind, we'll just do that fast. So this is a very broad historical view of, let's say, being willing to think outside the box about how we understand risk, return, public benefit, private gain, all these things. I would say after the period of acceleration that was shown on the previous slide, which is in every category of existence, population, CO2, speed of capital, all these things, has to come a century of reintegration. And that reintegration, when it comes to money, would come to reimagining the relationship between investing and philanthropy. And I think if you just look at those words, you can kind of see what they mean. There's just a lot of values that have to be reintegrated and re-understood. And just to wrap up fast, I'm so glad I put this one in here because Dan Imhoff was talking about the need for poetry. Remember, he was referring to Wendell Berry. This is actually a poem. And the poem is, I'm not going to say it's a great poem, but it is a poem. And I'll just read it. Circulation versus percolation. Monoculture versus diversity. Transaction versus relationship. And profitability versus fertility. The values on the left are the paradigm of the 20th century, let's say, or of industrial agriculture, the scientific revolution, globalization. It's all about circulation, monoculture meaning commodifying things, getting them as uniform and as cheap as you can, about transactions, efficient markets, getting money to flow as fast as possible, and about profitability. And in the 21st century, we need to optimize for percolation, diversity, relationship, and fertility. That to me is more of a nurture capital model, and I will stop there.
So I'll let you sit down here.
Oh, sorry.
No, go ahead. I have a lot of questions myself that I'd like to ask the panelists, but I feel in the interest of giving the audience a chance, I'm going to circulate a mic for the audience to speak, but I am going to steal it back as well because I have a few questions of my own that I'd like to ask. So you have a question back there? I'll bring the mic over. You have to hold it very close to your mouth.
Hi, I'm John Masuris. I have the feeling that what I'm hearing from multiple places in this panel, that I'm hearing something that gives me a sense of optimism, because what I'm hearing is that the cheater economy, the cheat is actually much deeper than meets the eye, because it's not, there's this premise that industrial agriculture is more economic than organic agriculture if you ignore the externalities. But actually, it's not more economic, even if you do ignore the externalities. It's been hyper-marketed, the GMO seeds but it's not what you said was that your costs are reduced once the land heals and you actually make more money, even without paying attention to the premium price and the externalities. And I think, I personally experienced as a child, my father was an illegal immigrant and we didn't have any money, but we ate well because we avoided industrial food. And, recently it was published a book about the Blue Zones. All the societies that live long, the one thing they have in common is they all eat beans. Beans are cheap, they store for a long time. You can cook a pot of them on the weekend and eat them all week, not labor intensive. The McDonald's and the industrial food is not cheaper. It's not more convenient. That's all a lie. It's a gigantic marketing fiction that's been created. So all of this, I think this all is quite relevant to disadvantaged people. I personally have experienced it. The workers in your sustainable ag land are going to be a lot healthier than workers in chemicalized industrial land that you have displaced. So I think all the boats are going to rise with this, and I think we're about to see what we're seeing in the fossil fuel industry, where the coal companies are going out of business, and solar electricity is actually cheaper than fossil electricity, even without the externalities being measured. That's a real turning point. Do you agree? I guess the banks are beginning to agree, right? That's the middle part of the panel.
I'll just add one quick thing there. Two things, actually. So I grew up in Berkeley, right next door to Oakland, and one of the things that's very important to us, to our values, but doesn't come across in an investment presentation, is the worker side of it. About 30% of the employees don't speak English for our companies. We actually acquired a farming company that actually went bankrupt, and are teaching them all basically the organic side of agriculture. And one of the nice things about sustainable agriculture is that it provides year-round jobs. The farmland is always working, so it's not just the seasonal work. And one of the things that was important to us at the company we acquired was that the employees didn't have health insurance. And the employees, one of them in particular with kids, actually in order to get medical coverage, actually had to go to their church and stand up and ask for money from the church in order to take his kid to the doctor. And so we were able to actually provide health insurance for the whole company. And so it's not the very bottom of the pyramid, but it's that step up, and then giving those workers the opportunity to get access to land. The farmland that's worth $2.4 trillion, 75 years ago, 150 to 75 years ago, farmland in the United States was given away in the Homestead Acts. So you got 160 acres to 320 acres of land. That land is now worth $2.4 trillion. There's no way for the next generation of farmers to get access to that land, and it's the next generation that are the most driven for sustainable agriculture. So ours is one way of helping convert that. And beans, by the way, really quick, I'm amazed at the low price of beans. They are essential to restoring the natural soil fertility of the land. If there's one thing you could do to help sustainable agriculture, is actually eat more beans.
So, Craig, I feel like you addressed part of John's questions and comment, but I would put it, I think the question he was asking, to put it much more just sort of bluntly and focused, is it cheaper to produce food sustainably and organically the way that your biodiverse farms do? Is it cheaper?
At scale, after you restore the soil fertility. Restoring that soil fertility is more expensive, it's more work. The average commodity farmer in the United States has $8 million worth of land and equipment. Okay, that's the average scale of the food that's priced in the U.S. The average organic farm is not $8 million in scale. And so that's why this scale becomes so important. That's why we're at the very early stages of organic food in the United States. We're basically, the cell phones that we all have. Well, we're basically at the Wall Street version with the big brick phones, with the people carrying the big batteries, talking on the cable. That's where we are today in the world of organic food, and we'll get to the point where we're giving these away to people in third worlds, and they're building their whole economies. Street vendors are using the phones as their primary means of banking and supplying that they do in India and Africa right now. We're not there yet on organic food. We'll be there, but that's where we are in the cycle right now.
So I think you said yes, but if it's at scale and after a period of conversion. After you go, I'm going to want to come back to that because Libby asked a great question earlier to just quantify the amount of investment needed. And you mentioned earlier that one would need to convert $80 billion of land to produce organic food at the scale that current consumption would want. What I'd be interested in knowing is how much investment is that conversion going to entail? Not buying the land is not necessary to deploy. It's what is the investment cost that those farmers would take? Well, no, we can come back to, because I feel like
the quick answer is about 8 to 12% of the value of the land is what we invest into it in order to do the conversion process. So it's not a lot if you look at it as an existing as a land buyer. If you're going to improve that, 8 to 12% is not. It's a reasonable amount of improvement. If you're someone who's had that farmland for 50 or 100 years, 8 to 12% of the current cost of that land is a huge amount.
So
let me just say
okay.
a very quick thing, and this is not, as I'm getting ready to say this is not an argument or even a rebuttal. It's just another point on a map, because we need it all. And so what I'm going to say is, when you talk about scale, or you say at scale, there are different scales for all kinds of agriculture. And I don't know what Mariela might want to say about urban farming or community, whatever, but I'm not really going there per se. I'm just going to scale as a little bit more abstract. We are about to give loans in Carbondale to 3 young farmers who are each farming an average of 1 acre. They are going to gross around $35,000 an acre. Depends on who the farmer is and what they're doing. One of them is going to try to do more than that. So you just need to hear that. Elliot Coleman, who happens to be on the board of Slow Money, I'm proud to say, who's been doing this for about 50 years, grosses about $150,000 from about 1.5 acres in Maine. All right. Now, I'm not saying this is like the be-all and the end-all, and I'm not trying to actually give an answer to the thing here, other than to say it's up to each of us to decide, let's say, where our juices are in trying to create change. Because what we're really talking about is trying to create change. We're trying to change something. And the change can come from pure market forces, where the change we want can compete at a market level and an institutional level for dollars. I'm all for it. That's one kind of change. And then there's another kind of change, which is, let's say, smaller, more community-based, more local, and doesn't have the same metrics, but doesn't mean it's less important.
So I want to give time for another audience question. Okay, over here.
Hi, thank you. First off, your presentations were great, and Mariela, I really appreciate your perspective on this. It was really important to bring it to this conversation. My question is for Craig. Craig, I am a farmer. I live in the Willamette Valley of Oregon, so we're kind of neighbors. I was fortunate enough that I was able to purchase 70 acres of land. I'd consider myself in the new and young and beginning farmer category. And I want to to bring up a gripe that I hear among my neighbors and farmer colleagues, and that is that investment companies, whether it be Farmland LP purchasing organic agriculture or more conventional investment companies purchasing conventional agriculture, that is driving up the costs of land and even sometimes marginal land and making it nearly impossible for that next generation to get onto the land. And when you talk about people having to be land in order to have a political voice or a financial voice, I think it's an important component of the discussion of investment companies purchasing land and hiring people to work the land. And I was wondering if in your worlds, if you're having any conversation about maybe a pathway to ownership or something, so that we don't get to a situation where we have landless farmers.
As I said a little bit earlier, that to us the getting the next generation of farmers onto the land is the biggest issue facing people, that us and our governments we just have no idea about the scope and scale of the problem. It is a $2.4 trillion problem. How do you pass the current wealth of farmland onto the next generation? And so our little way of doing it is to, I don't own my own office building, right? I rent my office building. When I need more space, I rent more. So we actually make sure that our land is certified organic, it's sustainably managed, that the proper crop and livestock rotations are there, and that as people grow their businesses, they can actually just get access to more land so that they can serve their customers. And that provides a pathway for ownership for them. They are now bankable. We actually work with the banks to make sure that they understand that they look at our numbers and they go, oh, you guys are actually more profitable. This organic thing isn't crazy. And so that's one of the pathways that we have there. Long-term, hypothetically speaking, we'd love to be publicly traded so that anyone can invest in the farmland that we own and manage, and make it very democratic. We view that as the capitalists' cooperative in a lot of ways. The price of farmland is driven by so many factors. The subsidies for commodity crops is, to me, actually the largest issue there for me. But it's in some ways just the water that we swim in, and we just have to be able to buy it and make sure that it's managed well, and it's the big issue.
Okay, one more question.
Hey, Ali, can I add something to that really quick? Sorry, before you go on. I just wanted to double down on that, because that's such a great question, and I have no idea what the answer is. But with the farmers that we work with, I think that's their biggest problem. And in fact, leasing the land it's not a solution, specifically because they're not, at least in Santa Cruz Valley and Fresno Valley, they're not long-term leases. So what ends up happening for the small farmers who are trying to work organic is that they spend a year or 3 years or 5 years converting the land to organic, and then they lose the land when it gets sold. Like, one of our farmers just lost land to a big investment company that bought a bunch of the land. So then they're having, when they move to the new land, that certification they spent 3 years getting doesn't go with them. It stays with the land, right? So then when they move to the new land, they have to start all over. And then that creates, in California specifically, where a lot of the farmers are dependent on farmers markets, it creates another problem because they lose immediately what is 80% of their income. They don't have a diversified income, right? So they lose the certification, so then they lose all of the farmers markets that they were in already. And then when they get the land recertified, they have to reapply, and then they're on a wait list of 100 people. So I just wanted to highlight that is such an excellent question. I don't have the answer for it, but I know it's a gripe amongst farmers generally around leasing land and the importance of ownership.
So there's no ultimate resolution of this, but I think there is a kind of a compromise or an intermediate position, which is, if every pension fund in the world invested in the next 10 partnerships Craig does, and 1 million people who live in local communities all did Poudre Valley Community Farm Co-ops to buy the land, then we'd be better off than we are now. Meaning we need a lot of both. We need community ownership of land, of smaller parcels, because to me, what keeps me awake at night and drives me to do Slow Money is the idea that we're thinking only about these institutions as if they exist in the abstract, and we're not doing the right thing with our own money. It's got to be both. We got to get the institutions to do larger scale things because there's trillions of dollars of stuff out there, and then we need community. When I say community people, I don't just mean people of color or people in the inner city. I mean people who live in places who are connecting to one another across a variety of barriers and taking smaller amounts of our money and doing the right thing with it. Between the two of them, I think we can solve it, but it would take a lot of both. So.
Yeah, a very interesting discussion, and couple of a comment first. Somebody said, I think it was you, we don't know how much it costs to transform agriculture. Actually, if you go to UNEP Green Economy Report, published 2011, we implemented in a very complex simulation model the implementation of the ag assessment, basically moving on a global scale to agroecology. It costs 1/3 of the subsidies given every year to agriculture. 1/3. With $140 billion, the next 40 years, we can transform the global agriculture. And actually, we have more money, so we could go faster. It's been calculated, it's all there, and we did all this sort of in the background of UNEP with our modeling. So I think we know how much it costs. That's what, and think about it, 1/3 of the subsidies which are given today, most actually to do the wrong thing. So I think that's one thing. But I want to go back to sort of this, your program, because those farmers who lease the land, for how long can they get it for? And would it be not an idea to say, all right, why don't you make it like a mortgage? So after 30 years, they even own the land. You know, that's maybe a different model, so you're not there for perpetuity, but it will recreate this fabric in the rural areas. Because, I mean, people have, you know, if you have 10,000 acres somewhere, where are the people? And if you just lease the land to them, do they actually live there? No, because they don't know how long they're going to have it, right? So I'm just wondering, you know, if there is maybe a better long-term plan than just to lease land, to do it, you know, to improve it and lease it out. And also, I was wondering, you know, we call it organic because organic is not necessarily sustainable, as we know. Go down to Salinas, maybe totally organic. It is zero sustainability because they import most of the nutrients into the farm. So are you having a model which is truly sustainable? I mean, the animals are there, that's good, but do you really make sure it is according to agroecological principles, right? The 3 dimensions, economics, environment, and society, social.
The co-founder of the company is a PhD in biology and an expert in sustainable agriculture. My degree is in biochemistry and molecular biology. So we both focus on maximizing the soil biology, the soil fertility, and that's in a very archetypal way is 3 to 5 years of pasture, rotating into vegetables for 1 to 2 years, rotating into grains for a year, then back into pasture. That's the general agroecological rotation that we do, and we track, and that's how we manage the land. And it's not everyone can be Joel Salatin, right? He does amazing things. As you scale up a Joel Salatin practice, you end up kind of naturally evolving to specialists. And one of the livestock specialists, cattle, sheep, pigs, etc., vegetable specialists, grain, not only for producing the crops, but also for marketing and distributing those crops. It's a hard enough job being a farmer if you focus on one crop. That's why corn, soy is the dominant rotation in the U.S. I don't really call it a rotation, but that's what sort of it technically is. The reason why we buy and then lease out the farmland is because the specialization that we provide is agroecological management of the land. We get the land certified organic. We are responsible and accountable for the crop rotations on that land, and then finding the best farmers to grow the best crops at the right scale all the time. And it's actually a specialty that we're expert at. We're large enough now that we can actually attract some of the really best people who are great at, hey, how do you optimize the pasture growth for that land using savory methods or people who've worked with Joel Salatin. So there's really true expertise that we're able to provide at a scale that's pretty unique. And yes, ours is just one way of doing it. You know, it's small. We're demonstrating what we do, but the economics are there. So, and the again that the cooperative idea is okay. We can actually work within the capitalist system, take it public, and we can feel good that anyone can then, with $10 or so, it doesn't have to be an accredited investor, it doesn't have to be an institutional investor, can actually be a part of owning sustainably managed farmland or helping convert more organic and sustainably managed farmland. So that gets us up in the morning. So hope that answers your question.
The question was if you can give stock options to the farmers.
But don't
in
be
the
naive.
land.
I mean, there's like a naive thing here that farmers live forever and they just pass the land on to other farmers. Doesn't happen. Farmers sell land to developers. That's how they make their retirement. So don't think that just because you get the next generation of farmers on, you've solved the problem. So, and again, this is not an argument. These are imponderables. We're talking about assets and people and retirement and whatever. So I continue to be intrigued, but there's not enough public money to do conservation restrictions or agricultural preservation easements on all the farmland in the country, right? So unless that's the $2.4 trillion.
I think on this issue, there's an implicit assumption that in order for the farmer to have equity and to have stability and long-term wealth, they need to also own that land and be permanently attached to it. And I don't think that that's necessarily a true assumption.
Right.
As Craig mentioned, I mean, any of us here who works in a office building probably does not own that office building. And same with almost all commercial real estate. So equity ownership, yes, I agree. In something. Walgreens is a good example. Walgreens does not own any of their buildings. They are a huge business that started small and grew, and they do have tremendous wealth concentrated in there.
Trucks to apples, right? Like if we're actually talking about organic land, then you do have I would disagree completely. Like you do have to have farm ownership of the land at some point, because then their investment is directly in the land. It's not just in an ethereal business or a tech product or the stuff, the inventory in the store. Like you're actually farming the land, right? So I don't think it's a
farmer is building a brand, especially the farmers that sell at farmers markets have a brand.
But the organic certification is on the land,
so
right?
They could, if they expand, they can expand to new land. The consumer
but
doesn't know.
I think that context is.
So the other thing I'd say is the organic business, if we heard correctly, is lower in cost at after a conversion period, and higher in revenue. So it's extremely profitable. You both have a higher revenue and lower cost, and it's the fastest growing part of the food business. Which means, to me, it seems that if you are doing it well, you should not only have a profitable business, but also have the potential to expand rather than to be displaced.
I think that if you talk to any farmer that's considered a small farmer, they would disagree with you. I think
to a ton of small
I think what
farmers.
you're talking about is people who have direct channels to institutional buyers. Like if you're talking to farmers who sell at Walmart, sure, of course, then it's an infinite world of selling more and more and more. But I would say that if you're talking to small farmers, really small, and actually I would want to hear your input since you're actually a farmer, like they're not selling enough of their crop. It's not that they're not good business people. It's not that they don't have good growing practices. And I do think that the thing that most deters their ability to grow is having steady land. Now, whether that's a lease to own situation, like that's something that makes sense to me. But I do think that there is a long-term equity in ownership. Like I think dismissing.
Or in other things. There's long-term equity to be built in a business or in the land. I don't think
it's a versus situation, right? I think you're looking at institutional or larger things, which that totally makes sense. But if you're talking about individual small farmers that will continue, like that their sons are wanting, or their daughters are going to want to continue to farm, it's a totally different mechanism.
Marielle, I have a question. We're never going to solve this because this is an imponderable of human existence. We're talking about land ownership.
But what I mean to say is that I don't think it's a versus situation. I think saying that's not at all a solution is not the right thing.
No. But I just wanted to ask you a question. There was an assumption implicit in what you just said, which I think is where Ali was trying to go. You said a farm family that wants to own it and pass it on to their children. But what if the farm family doesn't want to pass it on to their children?
That's
What
true,
happens to the next
But
generation?
there are ones that do.
There are.
Right?
So figuring
and
out some solution to the long term, keeping the land in agriculture long term.
And I think that this investment and passing it on is that the kids don't see it as a viable business, right? Or that it's too hard. I don't think it's that the kids grow up and they're like, oh, we want to go into something totally different. It's that they've seen how hard it is to farm. Farming is freaking hard, right? And they've seen what it is like to lose their land, to lose their organic certification, to have a planter, fail and then be screwed for 6 months to a year. So I guess I don't want to talk in extremes, because I think we are, like what you were saying, like the context that you're putting it in, which is there's global, there's local, there's industrial, there's individual, and I think that in all those scenarios, the best case scenario, it looks very, very different. And I think that there's a disservice we do when we put a model. We're talking about large, we're talking about a large business model on a family farmer. Like they don't, the same way that you wouldn't put a family farming model on Walmart, right? So I just want to be able to have the conversation open to that and not have it have to be one or the other.
I think this should be the last comment because we're up for time.
Yeah. So I was just saying it's really an aspect of sustainability to me. So the ownership and whether that's achieved in the near term, right, or over the long term, that you return the land or a large degree, a large percentage of the land back to the farmers is an aspect of sustainability. Right, which is what we're all trying to achieve.
I think we're going to have to close. Sorry, because 3:30 is the ending time, and we've got.
Hey, there's something called the Slow Money Journal that we just published for the first time, and I'm going over to the book table there. We're just giving it away if anybody wants to see one. It just tells you a little bit what we're doing. And by the way, I'm very disheartened that no one seemed to like my poem. Just gonna,
Wait, did you write that? Did you write that poem?
I did.
Oh, I didn't know you wrote it. I thought you just picked it up from somewhere.
Thank you, everybody.